Hello, everyone. Thanks for joining us today. Welcome to our farm depreciation update. My name is Sarah Campbell. I'm USDA's National Beginning Farmer and Rancher Coordinator, emceeing and assisting Bob Ray from the University of Illinois Tech School today. And just I'm making a few quick announcements and then I'm going to hand it over. Just as a reminder, it's in the chat here, but this session is being recorded and it will be posted online on farmers.gov/taxes. It usually takes us about 2 weeks to do that, and you will be notified by email when the recording and the slide deck have been posted. If you have questions during the chat, please put them in the Q&A box and we will get through as many as we can at the end of the session. Also, there are a lot of additional resources on farmers.gov/taxes. This webinar is being presented as part of our partnership with the National Farm Income Tax Committee, and we've been working to get lots of helpful information regarding USDA program payments out to farmers and ranchers. So I'm going to hand it over to Bob now, and thank you all for joining us.
Well, good afternoon, everybody. Thank you, Sarah. Great to be with all of you today to talk about farm taxation and more specifically about depreciation rules that are new and different for 25 and 2026. We'll also talk about some things that haven't changed, but we'll talk about all of these on this timely topic as we're just getting into the heart of income tax preparation season, especially for our farm clients who might have chosen to make March 1 their filing date. We are in, just a couple of weeks to make sure we get all of those returns completed. So this information will be hopefully useful as you think about preparing 25's tax return, in addition to planning ahead for 2026 results. As Sarah mentioned, this is part of our work from USDA and the National Farm Income Tax Extension Committee. So here's our acknowledgement and disclaimer of that. As Sarah mentioned, this is a project that's been ongoing for a while, and we've had several good opportunities to share information from our Rural Tax Education Group. It can be found on a ruraltax.org website, and even more importantly, it's developed and managed and overseen by members of the National Farm Income Tax Extension Committee. I'm pleased to represent the University of Illinois Tax School as a member on that group. And really, I want to say my colleagues on that group, the best farm tax experts in our United States of America for sure, who meet every month to talk about hot topics. We just met on Monday, and then each year they do a full review of tax materials in addition to these ongoing webinars. Today we'll talk about four things. What's new in the Farmer's Tax Guide? We'll talk about the 25 and 2026 reporting rules, specifically about depreciation. We have some examples of how to calculate a depreciation deduction for you as the farmer or for your farm clients if you're a tax professional. And we'll also take a look at the slightly different Form 4562. This information has its beginnings from publication 225, the Farmer's Tax Guide. And folks, as you can tell, I've been doing this a while, right? So in my 42nd year, the Farmer's Tax Guide has been around longer than that to tell us key information for our farm clients on the best methods to report income, expense, deductions, credits, self-employment tax, estimated tax payments. All things related to a farm tax return are found in this document. And one of the key things that the National Farm Income Tax Extension Committee does each year is review every page, every column, every paragraph of this document. We've just completed that about a week ago. We sent information to the Internal Revenue Service for their consideration on updates to this very useful publication that comes out in October of each year ahead of the filing season. It is by far the most valuable piece of information you can find for farm tax return preparation. As we think about what is our statutory authority, who tells us what to do? Well, the Farmer's Tax Guide is not that statutory authority, but it's the user's guide to the statutory authority. It will identify cases, it will identify regulations, it will identify code sections that are the statutory authority for helping us find the right answers for our farm taxpayers. So, if you're doing a farm tax return, you need more information. The first thing that I search for is Pub 225. It'll pop up. Do your search key to find the words you're interested in. The table of contents are highlighted and take you right to the table, to the chapter that is of interest for you and or your client. Great publication, been around a long time. We're going to start our discussion today in chapter 7 of this publication. It's called Depletion, and Amortization. Gosh, I just almost messed that up, Sarah. When we were teaching tax schools this fall, my friend Jerry came up with this new word that I'd never heard before, and I just said it myself, depreciation. It's not a thing. It's just depletion. But oh my gosh, Jerry, you just caught me there with that word. We'll spend our time talking about depreciation today, and here are a few highlights that are in the What's New section of IRS Pub 225. On the left-hand side of your screen, you see the increased Section 179 expense deduction limits. That came about by the One Big Beautiful Bill Act signed July 4th of 2025. We can deduct up to $2.5 million in the 179 deduction. On July the 3rd, that number was half that, 1,250,000. In addition, we get to use that full 179 amount of 2.5 million until the taxpayer spends $4 million. If they spend over 4 million, they start to reduce that eligible 2.5 million dollar for dollar. We'll show an example of how that works in a moment. On the right-hand side of the screen, these are about the special depreciation allowance, often called bonus depreciation. This had been on a scheduled decline over time since the Tax Cuts and Jobs Act was signed into law in 2017. We had a 100% bonus for a while, then 80, then 60. We were scheduled for 2025 to have 40% bonus depreciation, which we had until July the 4th of 2025. And then it became 100%. That's the second paragraph, but only for property acquired and placed in service after January 19th of 2025. We introduce a new term that we've never had before called qualified production property. It also is available to utilize a 100% special depreciation allowance if it's placed in service. Here's a different date though, July the 4th of 2025 and before January 1 of 2031. The middle paragraph, the 100% bonus for what we would call our typical farm property, is now made permanent. It is permanent, meaning it doesn't have an expiration date like the third paragraph below it does. So we know that Congress can meet, change, new legislation, new focus, new economic reasons. Even though tax law is called permanent, it's only so until it gets changed again. It always seems to get changed, and that's okay. So let's talk with a very basic definition about depreciating property. And this is also from Pub 225, the source of all the things we're talking about today. Well, what can we depreciate on a farm for our farm clients? Well, it has to be tangible property, meaning it has to be something that's real. Here's a wall right behind me. My laptop is sitting on a desk right below me. Out the window, I see a truck. I'm sure there's a tractor going by somewhere. Those are tangible property items. I'm bringing this to you by my laptop computer, another piece of tangible property. Land is excluded. Land does not get depreciated, but all other types of tangible property are eligible for this depreciation deduction. Certain intangible property can also be depreciated, and to be depreciated, it has to be something that you own. It has to be used in your trade or business or an income producing activity like a rental property activity. It must have a determinable useful life, meaning It's set by the IRS that a truck has a 5-year determinable useful life. It's a 5-year property. Certain breeding livestock is 3 years. Single-use ag structures, 10 years. A determinable useful life as determined by the IRS. And that useful life that's determined must extend substantially beyond the year you place it in service, more than 1 year. In fact, the shortest depreciation that I think about on our farm clients is a 3-year breeding stock item. So at least that long, used in my trader business, has a determinable life as set by IRS definitions. We might also throw out this other publication, IRS publication 946. It's the depreciation publication. So while the Farmer's Tax Guide tells us specifics about the farm clients and maybe from a broader general overview, to dig deeper into the depreciation rules, look at publication 946. Okay, so what happens for things that we purchased in 2025? We're getting ready to prepare these tax returns, some with a due date of March 1. Some of our S corporation and partnerships have a due date of March 15th. And some individuals have made estimated payments and they have a due date of April 15th. All within another 60 days about, we will prepare lots of tax returns regarding farm business activities. So if I have a 2025 purchase, I go through this order on determining what deductions are available to me or to my client. I first make my determination about the Internal Revenue Code section 179 expense election. That's the $2.5 million maximum amount up to a $4 million purchase threshold. Over that threshold, I have to give away part of my $2.5 million deduction. I determine that first. Once I made that determination, I then turn to deciding, am I going to use any of the bonus depreciation, also called the special allowance for depreciation? And I can choose none of this bonus. I can choose 40% in 2025, and I might be able to choose 100%, but I have to make that determination initially and then make an election on my tax return to which of those that I am using. And let me maybe state that differently. I'm going to get bonus automatically. I have to make an election to not use one or two of these three options. Once I've made my 179 choice, number one, then I made my bonus choice, number two, then I go to number three. Whatever's left over that I haven't taken goes into my regular depreciation deduction, calculated on Form 4562, probably using MAKERS, the Modified Accelerated Cost Recovery System for our farm clients using 150% or 200% declining balance. Those are the normal ways that we do depreciation. Now, we also recognize that states don't follow those same federal rules. In Illinois, we can use the same expense election, but we can't use any bonus depreciation. And other states, there's a limit on how much each of those you can use. Every state, different set of rules. So whatever state your taxpayer is filing a return for, make sure you understand that that state provision is likely different than the federal provisions. And we have this final reminder about 2025 purchases. These are personal property things because they're being depreciated, and we can no longer use like-kind exchanges on those. So we need to know if somebody traded in an item. We need to know two things. What was the fair market value of the item traded in? Because that's going to be reported as a sale on Form 4797. And secondly, what was the full purchase price of the item acquired? And I'll show you an example of how that works in a moment. No like-kind exchanges for personal property items any longer. Well, in Pub 225, Table 7-1 shows us all types of farm property classifications and what the recovery period is under GDS or the General Depreciation System, or ADS, the alternate system. And we start alphabetically here with ag structures. These are single purpose ag structures. I define those for us in a moment. That's a 10-year recovery life. I'll jump down to new farm equipment, 5 years. Used farm equipment, 7 years for those. Non-residential real property, 39 years. Well, I'm not sure what I would have in my farm that might be that, but it's a reminder of the big difference between farm property and non-farm property. If I jump to the residential real property, 27 and a half years. If I go up a little bit in the chart to farm buildings, 20-year life. So if I build a general purpose shed used in my farming activity, it's a 20-year property, which means it's eligible for 100% bonus. If instead I build a general purpose building that's used in my construction business, it's non-residential real property, 39-year life, not eligible for 100% bonus deductions here. So when we brought the 100% bonus rule back under OB3, it really makes a difference on proper classifications for the property class lives. And I'll show you an example about bonus in a moment that adds a little more depth to that piece. Well, here's our reminder again about the 179 expense amount for 2025. And note the definition here, it's key. For tax years beginning on or after January 1 of 2025. So my calendar year taxpayer, they're in. $2.5 million is the limit, even though we didn't know that until July the 4th of 2025. Conversely, if I have a fiscal year C corporation whose year ends at the end of this month, February 28th of 25, they're not in this rule yet because they haven't had a tax year start yet after January 1 of 25. They won't get these higher limits until March 1 of 2025. So fiscal year entities, be cautious because this rule isn't hitting them quite yet. And here's my example. If we have a purchases of 4.1 million, it's 100,000 over the 4 million phase out threshold. And so this taxpayer's maximum 179 deduction then is lowered to 2.4 million, not the full 2.5. Most farm assets are going to be eligible for this if they have a class life of 15 years or less. New property, yes. Used property, absolutely. Related party acquisitions, though, not going to qualify here. Father to son, son to father, those are related party transactions. They do not qualify. But this is a fun one here. Brothers, sisters, siblings, not related parties for these rules. So from me to my brother Mark, yeah, that's an eligible 179 purchase if I buy from my brother. And this is a phrase we've used a long time. It's got to be placed into service. It's got to be paid for and placed into service. And what does that mean? Here's what I've gathered over my years that I like to say. The property is in a state of readiness for its intended use. And we get that quite a bit, like with a farm machine shed. You know, they started construction on it December 20th. I paid for it on December 21st. Can I use that amount as a 100% bonus deduction in 2025? My answer is I doubt it. It's probably not in a state of readiness for its intended use as a machine shed. There might not be anything constructed yet. And we look at the same thing if people are buying items of equipment that are on order and haven't even been built yet, that has to be in a state of readiness for its intended use and paid for as well. So beginning next year, so here's our first look at 2026. The current year that we're in, for years beginning on or after 2026, we get higher limits, 2.5 and $60,000 more for the maximum 179 deduction, 2.5 million up 60,000 The 4 million purchase limit has jumped a little bit to 4,090,000. Each of these are inflated by the IRS in a notice that they issue in October of each year. So we know well in advance of what the rules are for next year. If we have the same $4.1 million worth of purchases in 2026, their maximum 179 deduction is still pretty high, 2,550,000. Two things happened here. The limit went up and their purchase limit went up as well. So they're only $10,000 over the limit. So they only lose 2,550,000, or they can still deduct 2,550,000. And recall that in 2025, that maximum was only 2.4 million as a deduction. So we have the same rules, related parties, siblings are not related, in a state of readiness for its intended use. What about bonus depreciation rules? Well, this is a look back to what we had been dealing with. This goes all the way back to after 9/11. We had bonus that came back in as an economic recovery. It was gone for a few years. It came back in during the financial crisis of 08, 09. We got back to 100% bonus for a while. It then dropped to 50%. Came back for part of TCJA, was here for 1, 2, 3, 4, 5 years under TCJA at 100% through 2022. Then it went to 80, then 60. 40% for this year was scheduled to drop to 20%. And of course, these last two lines here, 25 and 26, have been modified by OB3 as of July 4th of 2025. We've been in a phase out, but now we have a permanent rule at 100% bonus. But it's not quite that simple for 2025. We have choices, which is good. We didn't know that was changing until July the 4th, so IRS gives us some flexibility. They say for assets acquired before January 20th of 2025, well, we have to use 40%. We're only eligible for the 40% rule for assets acquired before that date. If assets are acquired after January 19th, then we're eligible for a 100% bonus rule. That's what OB3 said, signed in July, but this one was retroactive only to January 19th, after January 19th. So if I buy a tractor on January 10th of 2025, it's a 40% bonus. That's my only choice for that tractor if I'm going to use bonus. If I buy a second tractor on today, February the 11th, then it's eligible for a 100% bonus. So I can have two tractors bought within a month. One stuck on a 40% level, the other one is eligible for a 100% level. And here's the transition rule that IRS provided because we didn't know these rules until July. IRS says you can choose to use 40% on everything you have in 2025, but you have to use 40% on everything you have in 2025 if you make that election. No picking and choosing. You're either all in at 40%, or you're one of the first two lines, 40% for the first 19 days and 100% for the remainder of 2025. Here's another little twist. You have to consider what was the date of the written agreement that was made to acquire this property. So if I signed a deal on December 15th of 2024 to buy a truck used in my farm business, it's not delivered until March 15th. It's paid for March 15th. It's placed into service March 15th. I'm stuck at the 40% rule because I had a written contract to acquire that property well before January 20th of 2025. So as we're thinking about preparing returns new this year, when was the deal made to acquire the property, especially for these early year transactions? We need to find out if there was a purchase agreement before January 19th or before January 20th that will require us to use the 40% rule. If none of that happened, we're eligible for 100% bonus. All farm assets are in this mix. New and used property, yes. We're now into machine sheds, which are 20-year property. The 179 stops at the 15-year property. This takes us up to 20-year property. Same rule about related parties. Can't use it from father to son. Grandfather, grandson, nope, can't use it. Spouse to spouse, no, can't use it. Siblings, not related parties, and the same rule in a state of readiness. So what about for 2026? Well, we strike a couple. We don't care about the 40% provisions. We're into 100% bonus for assets acquired after January 19th of 2025. Well, maybe an asterisk here, What if I really signed a deal to acquire the property, excuse me, January 5th of 2025, but I didn't get it, the property, until January of 2026? I think I'm back to the 40% rule. Only eligible for that piece. I must also consider the written date. Hopefully a rare issue. All these assets are still going to be available in 2026. Here's a couple of cautions, though, about using bonus depreciation that's different than the 179 deduction. And remember, we've made our 179 deduction choice first, and now we're deciding choice two. Are we using bonus? And if we are we using at the 40 or the 100% level? So bonus depreciation is automatic. For each class life, the IRS has said you're claiming bonus on each class life unless you make an election not to use bonus for a specific class life. Again, critical that we put class lives into pretty critical we put property into the appropriate class life, because maybe I want to use bonus on my 20-year property. So I get deducted all in 1 year instead of over 20. I like that answer. But I don't want to use it on my 3-year property because I want to save those deductions, for time that I'm going to use them producing income going forward. So I could elect out of my 20-year class life. I'm already automatically in for my 3-year. And so there, between class lives, I can make two different choices. I have to make that election, file it with my tax return, class by class. Again, defining which class life each property is in is very, very important to the process. The 179 deduction, this is not automatic. We have to choose how much we're going to claim. And I can choose any specific dollar amount on any eligible class life property. So I have a $50,000 truck purchase used in my farm business. I can choose zero. I can choose $50,000 or any number in between. If I want my 179 deduction to be $28,362, I can do that. And maybe I want that because that gets me to the right taxable income for my tax bracket, for earned income credit, for my health insurance amount, whatever reason, I can pick a very specific dollar amount for that 179 deduction. Bonus, differently though, is claimed or not on all assets in that class life. So all 20-year property is in or it's not. All 7-year property is bonus or it's not. And remember, this year we have things prior to January 20th, a 40% rate, after January 19th, a 100% rate, unless we choose to use 40% on everything. The 179 deduction cannot be used to create a loss. Conversely, bonus can be used to create a tax loss. 179 can't be used greater than my allowed trade or business income. Bonus can be used by more taxpayers and more activities. For example, a cash rent landlord can use bonus deductions. A residential real property activity on Schedule E can use bonus. A passive activity taxpayer in a farming enterprise can benefit from bonus deductions, but they cannot benefit from the 179 deduction. A trust can use bonus depreciation to lower its taxable income. A trust cannot use the 179 deduction to lower its taxable income. So a lot of different choices on who can use 179 and who can use bonus. We take the 179 deduction amount first, and once we choose that and we filed our return, the good news is during the statute of limitations for that tax return, we can choose to amend and change our 179 choice to a different amount. If I took a $50,000 179 deduction on my truck on my original filed return, and 18 months later I say, gosh, I wish I'd only taken 10. That's fine. You can amend the return, take a smaller 179 deduction. You'll have a little more regular depreciation, of course. If you didn't elect out a bonus, you might have a bonus deduction now available. And so be cautious about how those things work together. But the 179 amount can be taken on an amended return. The bonus deductions cannot. You're going to make that final decision when you file your return up through your extended due date. You can change it, but after that, you are in the bonus world. I defined this a little bit earlier. I want to talk a little bit about what are these single purpose agriculture or horticultural structures, because yes, they're eligible for the 179 deduction because they are 10-year property. Eligible for bonus too? Yes, absolutely. These are the specific definitions. We get a lot of questions about people building a single purpose structure and want to use the 179 deduction for that, but it's a little deeper than that. It's a single purpose ag structure or a horticultural structure. You see the definitions on the screen, and I'll add the last thing that's in red at the bottom. It must be used only for the purpose that qualified it. So if I built a single purpose ag structure, but instead chose to store commodities or supplies in that building, it's no longer a 10-year property, it's a 20-year property item. So be cautious about that definition. I think a lot of our farm taxpayers don't understand the little more narrow requirements to be a single purpose ag or horticulture structure. All right, let's look at a few examples, get into some math here on this Wednesday afternoon. So this is a trade-in of a tractor that had a fair value of $85,000. Its cost was $90,000 when purchased, fully depreciated. We're buying a replacement tractor that's worth $185,000. And so most farm taxpayers are going to say, I traded tractors for $100,000. And that's interesting, but it's irrelevant for tax anymore because we have to show both sides of this transaction. We're going to show a gain of $85,000 on Form 4797. Ordinary income, absolutely. Subject to self-employment tax, no. Generates qualified business income, it sure does. Subject to the 3.8% net investment income tax, nope, don't think so because it was used in my trade or business activity. Then I have the full purchase price, $185,000 for my tractor that I can use my depreciation choices on. I report that on Form 4562. It then comes over to my Schedule F and lowers my Schedule F income. And you can see from this example, what used to lower my Schedule F by $100,000 instead raises my 4797 by 85,000 and lowers my Schedule F by 185,000. Still the same net $100,000 reduction in overall income, but it comes from two different places, a gain on this 4797 and extra deductions on Schedule F. When that happens, I probably save some self-employment tax. The example that I ran, they saved $13,000. Again, if they have a loss, they've saved nothing, right? So it depends on each taxpayer's situation. And they're going to get the qualified business income deduction, well, on $100,000 less, right? $85,000 from my sale of the tractor, $185,000 new deduction. So I have ordinary gain, It helps me increase my cubit, but I have a larger loss that's going to lower my cubit as well. Well, here's a $100,000, whoops, tractor went too far, that without a trade-in. So a more simple one, what are my choices in 2025? So it's a used tractor, so I know it's 7-year property. And if it's the only purchase for the year, which my example is, I can use the 179 deduction up to the $100,000 amount. I want to take 90,000 for sure, 10,000 sure. If I'm otherwise eligible to use those amounts, and I want to take 62,312, sure can. Any dollar amount can be chosen as the 179 expense amount. Or, and once I make that choice, let's say I choose none, then I go to bonus and I could choose 100%. It's bought after January 19th, not subject to a purchase agreement before that date, placed into service in April. I can choose a $100,000 100% bonus choice in 2025. Or IRS says, because we didn't know the rules until July, I can still use the expected 40% rule. I can take a $40,000 deduction. I get a little more from my regular maker's deduction of 8571, and so I can choose 48,571. My third choice, no 179 and no bonus. If I choose that, my regular deduction is 14,286. So from this tractor purchase example, how much depreciation could a farmer get? Well, at least 14,286, all the way up to 100,000. And on bonus, it's either going to be 100 or it's going to be 48. You can see how that's lumpy, right? The 179 could be any number from 0 to $100,000. Here's a machine shed. Guys, when we have a 100% bonus, these are very valuable tax deductions. They're 20-year property, same thing here, bought in 2025, not subject to a prior purchase contract that would require me to use 40% bonus. 20-year property, but I can't use the 179 deduction. I can't use those on property that has a longer life than 15 years. So it's out, can't even make the choice. My choice then becomes 100% bonus. I can use the full $300,000 deduction, or in this 1 year, I can choose a 40% deduction, which would be 120,000. I get a little more regular depreciation on the other 60% over 20 years. So I could have 126,750, or I take no bonus at all, and my regular bonus and my regular depreciation, no bonus, no 179, 11,250. So what are my depreciation choices for a $300,000 machine shed? 11,000, 126,000, or 300,000. And you can see how these are pretty lumpy steps, right? 11 or 126 or 300. I don't have that dollar for dollar flexibility with the 179 deduction. In Illinois, we don't get any bonus, so I just calculated what it would be. It's the same as regular depreciation. Illinois only gives me a $11,250 deduction. If I chose the 300,000 federal bonus, my Illinois AGI is going to be $289,000 higher than my federal AGI. A lot more Illinois tax in the first year because I have to add back that full $300,000 deduction. This is another example of a large amount of purchases. They placed into service $4.3 million. They traded in 3.1. So they thought they would have new deductions of 1.2 million, right? That's the new, well, that's the old thought. I traded machinery, I spent 1.2 million, I have a deduction. And we know now it's not quite that simple. So I could take the $2.2 million 179 expense amount. I don't get 2.5 because I spent 300,000 over the limit, but I could get 2.2. I could use a 100% bonus of 4.3, or I could use the 40% bonus plus the makers and get 2.2 million in that manner. So my 179 deduction and my bonus is about, and my 40% bonus is about the same result. I could choose neither of the accelerated options. My regular deduction over a 5-year life for this new farm machinery would be $860,000. So again, many choices on this example to pick from. Remember here, I also have a $3.1 million sale to report on Form 4797. So I need some accelerated deductions because I have a pretty big deduct or gain, assuming the property is fully depreciated outright. Then I have a large gain on 4797. Here's a brief description of this new type of property that we've never had before called the qualified production property. It's a new code section 168 little n, and it's any portion of non-residential real property. So forget about tractors and trucks and combines and planters. We're in the real property definition here. Has to be used by taxpayers as a part of a qualified production activity in the U.S. Original use with the taxpayer started after January 19th of 2025. This is around only through year 2028. Designated by the taxpayer as qualified production property. Placed into service by January 1 of 2031. And here is the very unique definition on the last bullet point. Production shall not include activities other than ag production and chemical production. So there's only a couple types of activities that are in this mix of qualified production property. So we have an ag producer who builds a real property, non-residential real property, used in his production process. Maybe it is a dairy processing facility. That's going to qualify for this, and it's going to be qualifying as a 179 item. We've never used that before, so I'm curious to see what we learn in tax filing season on how effective we are about adopting these new rules about these qualified production property, real estate that can be used as a 179 deduction. And friends, we've never been able to do that before. Prior to 2023, sales of farm machinery were not included in gross income from farming. I'm sharing this with you for two reasons. It's still kind of new. And because of the slide I just showed a moment ago, when they had $3.1 million of sales on 4797, that they were needing to offset that with some of their $4.3 million of purchases, that type of situation could have easily made that taxpayer not meet the definition of a farmer for estimated tax purposes. And so we meaning the National Farm Tax Extension Committee, as we reviewed Pub 225, said this ought to be changed. And it took us a couple years, but it got done in 2023. And so now instead of having these large gains unintentionally disqualifying a taxpayer as a farmer and making them have to make more often regular or estimated tax payments, we made this change, and this change came about in Pub 225 in 2023. It's the last bullet point on the little section to the right of the screen. Sales of farm machinery are now in the definition of gross income from farming. And more specifically, it says gains from the sale of depreciable farm equipment reported on Form 4797. So this kind of, I think, unintended effect of eliminating personal property trades caused some taxpayers to not be a farmer for estimated tax purposes. That's better. That's been made. That has been improved. And that's the second reason I want to share that slide is things change. And it takes a lot of people to look a lot of things and make suggestions. And we are very happy to report that IRS accepted that suggestion, changed the rules, and it's kind of also changed how FSA is using farm machinery sales in the definition of farmers. So, you can make a difference, right? If you follow through what's happening and you see something that doesn't quite make sense, it's great to see how that got changed in this um, large internal revenue system, a service system. It's good that we can make a difference. Completing Form 4562, I'm going to show you what the new form looks like. We set up with this example. They have these three purchases of a grain bin, a tractor, and a combine in different months of the year. They're all eligible for the 179 deduction. They take the full amount on the grain bin, 800,000. They take part of it on a tractor. They take some bonus on the combine. And here's what their Form 4562 looks like for 2025. $2.5 million is the maximum. They spent 1.2 million. They're below the $4 million threshold, so we can still take up to 2.5 million. Well, they're only going to choose in column C $850,000, all of the grain bin, half of the tractor, and so they have an $850,000 179 deduction. Possible. On line 11, I put in a very broad, well, they have business income of $1 million, just so it's greater than the 850, meaning they have preserved the ability to take the full $850,000 amount. If line 11 was only 800,000, then on line 12 it would only be 800, and there would be 50,000 then on line 13, not allowed in 25, but carried over to 2026. They chose 300,000 on the special depreciation allowance for the combine. That's the 7 year property item. And so the grain bin is also a bonus depreciation item too. Let me jump back one slide, make sure I said that right. Oh no, the combine is new. So it's 5 year property, 5 year property on the combine. We made the choice to use it. We're going to elect out of using bonus on the two 7 year items, the grain bin and the tractor. We have on line 19C, here's the other $50,000 of the tractor that we didn't use. 7 years, half year property, half year convention. It's a used tractor, 200% declining balance. And we have a deduction here of 7,143 as our maker's deduction. So this taxpayer has 179 in place, has bonus in place, and regular depreciation. All three are in place for this taxpayer. And here's what's new, and I haven't gotten used to this yet, but my total depreciation number now is listed on page 2 of Form 4562. For all of the years in my career, it's been the last line on page 1 of Form 4562, but now it's rolled over to page 2 because we've added some other pieces to page 1. On line 22 now, they have a deduction of 1,157,143 as a combination of 179 bonus and their regular depreciation deduction. So new this year, the final answer is on page 2 of the Form 4562. And for me, that'll take a little while to get used to flipping over and finding the number that's over there. These are some other useful links that might be helpful if you want to dig deeper into any of the points that have been raised today. The ruraltax.org website is available for you. USDA's website is here. Sarah will tell us more about that. There's a link to the Pub 225, and there's also two groups who do a lot of tax education across the U.S. The Land Grant University Tax Education Foundation. That's the group you see on the lower left. And then I'm a member of the University of Illinois Tax School. We present tax information for mostly ag professionals who are seeking their annual continuing education requirements at the University of Illinois Tax School as well. Here's my contact information. Be glad to hear from anyone who has a follow-up to this question. But Sarah, I'm going to stop sharing. And if you want to come back on and join us, and I will start to look at both Q&A and I have another one here as well. This question came in: as a landowner, can I apply 100% bonus depreciation to capital improvements to land completed entirely in 2025, such as terrace, waterway restoration, or levees? Well, one of the first things I come about here is land itself not depreciable, but some of these structures could be. They have to have a determinable useful life, meaning we have to know that those things are going to wear out in some time period. But aside from that point, yes, they are eligible for depreciation in 2025. Here's the real point of the question. What if it was contracted and started in 2024, but completed, paid in full in 2025? The difference is 40% bonus is all that's going to be available for that type of activity, not eligible for a 100% because it was started before January 20th of 2025. The type of expenses in that question might be better suited to conservation deductions on Schedule F. So check out that line and the Schedule F instructions and see if conservation work is a better place for those deductions. There's some limits there too on how much you can use, but they might work. Mother, stepson, is this a relative? Yes, those are deemed to be related parties. They're lineal descendants, so I think those are relatives that would not be eligible for the 179 or bonus provisions. About the one exclusions is the siblings category. I'm over in the chat now, Sarah. I'm going to look at some of these questions. Um, the difference between the 179 and the 100% bonus. I hope we covered some of those for our question provider. The 179 is limited to business income. The bonus can take a full amount and create a loss. The 179 is dollar for dollar. The bonus has to be taken in class life. So all the 7-year property, none of the 5, all the 10, but a class life distinction. And certain taxpayers can use the bonus who can't use the 179 deduction. Qualified production property versus normal farm equipment. Well, the key difference between those two definitions is qualified production property is real property, so it's buildings. It's not a piece of equipment. It's not the milking machine. It's maybe the parlor that the milking occurs in, or maybe in dairy, a more specific one would be in a standalone building that's a processing facility. Also, important part of production process. So qualified production property, real estate is the key. Not available until 2026 versus 2025. Actually, Roger, I'm not sure what I said when I read that one, but you might be right. I might have not gotten that correct as I said that. Fruit packing shed. I think that's a good example of a qualified production property. Again, we're looking for more definitions. I just looked before we started the webinar. The Form 4562 instructions were not available except in draft form. So we're looking for more details about what really might be qualified production property, but that sure sounds like a good one. It's real estate. It's a critical step to the overall processing piece. I would say a fruit farm packing shed is now 179 eligible, was not in prior years. Again, I'll hedge my bets a little bit because the final instructions aren't fully available for that. And we're looking for more. We're looking to see what we learn about qualified production property. All right, that takes care of my presentation. That answers the questions that were posted. Sarah or Janet are going to come back and send you off on the rest of your Wednesday afternoon. Thanks for being a part of today's webinar. It was a lot of fun putting it together for you. Fun to share these pieces with you. And a huge shout out to my Farm Income Tax Extension Committee members from many universities and land grant institutions across our nation who helped make all this process work, including my friend Ruby Ward, who's on here right now. Ruby?
Thank you. I think that Janet or Sarah is going to close us out.
Hi, everyone. Thanks again for joining us today. Just as a reminder, this was recorded. It just usually takes us about 2 weeks because we actually caption and edit the videos, and then it gets